There we go. All right, going live. Hello, everybody. Welcome to the TraderMerlin Show for your Tuesday afternoon edition, a ruckus Tuesday afternoon. We'll talk about some of that economic data that we saw come through that really wasn't that pretty for the U.S. markets. I'll deal with that a little bit later on in the show. We'll look at a whole bunch of different charts today, but I want to get right into our topic because I hate making my guests wait. Today, we're going to revisit natural gas. Now, of course, we've had John Rowland on of barchart.com several times over the years, and he is probably my foremost expert with regards to natural gas. So I figured let's talk about natural gas today with John Rowland. How you doing, John?
Hello, Merlin.
There you are. Now, good to see you again, my friend. What's been new in your world?
Busy, right? Playing this bear market and in the equities, and then trying to keep my head low on trading natural gas. I mean, it's crazy, right?
Insane. It's funny that you brought this up. You were saying, I mean, obviously you didn't cause it, but because of your experience in the commodities markets, we were looking at price charts, and I remember back last year you were going, look, I expect there to be some higher highs, and I think actually back in 2021 you were saying $8 is my target. And I'll bring up the chart right now of natural gas. I actually wrote it down. You guys can see here. It says rolling target for a cold winter. He was talking about back in 2021. And we've just had this monster rip up. Now we're at $8. I mean, we've kissed 9. We've already hit that. Well, I can't say we've already hit it, right? We're at 8,996 on the futures. But I'll just round it up and say that we hit it. Are we going to see 10, 12, 15? What on earth is going on with natural gas? You've nailed your predictions before. I need new ones.
Well, let's get it right, because I came on your show back in April, and I put my neck on the line, and I said that by Memorial Day, we would see above $8. And so here it is.
Woohoo!
Memorial Day. Woo!
Hey, congrats.
Well, so, when we look at the fundamentals of natural gas, nothing's changed. The tailwinds are still there. We're still producing a lot of LNG and exporting it to Europe. That has not changed, and that was one of the dynamics that I said was going to drive natural gas prices higher. What has changed is, and I kind of hinted towards it the last time I was on, was that there isn't any spare capacity of LNG production here in the United States, and there won't be any new capacity until sometime in late 2023. So we're exporting about 12 BCFs a day to Europe, or Europe and Asia, and that's really as much as we can do. That's full balls, boom, all out. So that tailwind is at full max. It can't get any stronger. Now, what is happening is there is this, this crowding out effect of natural gas is moving from, storage, which is normally what happens at this time of year, to LNG, and so now the storage play is way behind. We're about 15% behind the 5-year average and about 20% behind last year's. So again, what is happening is our little domestic natural gas product is now being linked to the global markets, and that the valuations of what our natural gas is worth versus what the world price is coming into equilibrium, and that price could be a lot higher. It could be above $10, $12. I don't think that will happen until we get into our winter months, where our demand starts to really pick up. Now, the caveat between now and then is if we do get some warm weather, and I mean 100-degree weather across the mid-continent, or even in the East Coast, and then we see a lot of electricity burn for natural gas, and that would even crowd out storage play even more. But in the short run, I think what we're seeing in natural gas prices today is basically just an options play. We have option expiration coming up, and there's a lot of $8, $9, and $10 calls that are still open interest in, and I think what it is kind of a gamma squeeze that's going on. And then I think that after the options expiration for this contract month, then we'll settle back down into the range that we've been stuck in. And I think moving forward through the summertime, I think that range is somewhere between $6.50 and $9.60 on the upside. So I think, yeah, there's some room, not much, I think the catalyst will be super warm weather over the summer, and then we'll see what happens when we get into our demand season. And if we are behind the eight ball in terms of storage, that could be a dire recipe for super higher prices.
You mentioned, you said we're kind of we're maxed out right now. Well, if that's the case, and we're at summertime, which generally is not going to be the highest consumption period, and here we are at historic 5-year highs. Of course, you guys can see the chart that I had up here. Going back into 2008, we were right around that $14 mark. Well, not saying we're going to get there, but it does seem a little bit suspicious that if it's summertime and not really using natural gas and we're this high, as we start to get some cold temperatures roll in let's say August, September, October, that this could very easily be $12, $13.
Yeah, I agree with you 100%. Again, I'm really thinking more like towards like December, January. But again, the driver that could push natural gas to those super high prices that you see above $12 when you go back, 13, 14 years ago, 2008, that driver will be as if we're not putting gas in storage and gas is being burned to create electricity. In other words, not cool weather coming over the summer, but super warm weather, super hot weather, and they burn natural gas to create electricity. So that would be the driver that could get us to the next leg over the summertime. My feeling is that in the short run, what we've seen here is an option squeeze, and once that option squeeze is over, then I think we're going to fall back into this kind of this range that we've been in until we get a clear picture in terms of what storage is going to be. Again, as long as we're still falling 15, 20% behind year to year or 5-year averages, that would be a huge driver as we get closer towards, let's say, September and October.
Absolutely. Great question from Margaret. She says, John, who's to blame for this? I don't know if it's necessarily to blame, but there's obviously factors. Is it lack of inventory, lack of storage facilities? Is it global demand? You mentioned Europe and us becoming an exporter of it. I mean, what are the main catalysts here that have caused this? I mean, phenomenal, 150% since the beginning of the year. That's a pretty impressive run for a commodity.
Yeah, and if you really look at it, if you go look at the lows of 2020-21, we're up about 300%.
That's insane.
I mean, it's really insane, right? I mean, I think we were trading in 260s no more than a couple of years ago.
Yeah, if I go from the lows of 2020 to the peak that we had just a couple weeks ago, it's up 513%.
Yeah, it's transitory inflation, right?
Yeah, nothing to see here, folks.
No, that's it. So, I'm not a political person. I don't want to get into that discussion, but certainly the current administration has not been very supportive of the hydrocarbon markets. Production and, production had been weaned. And so there wasn't a lot of new E&P, new production coming online, but we're still producing natural gas at historically high levels. I mean, so it's not really the production picture; it's really the demand picture, right? Inflation, and Europe, right? Remember we talked about LNG. No more than just a couple of years ago, we were only sending about 4 billion BCFs, a day. Exporting. Now we're exporting a full 12 BCFs a day. That's 3 times what we normally would. That is really the driver, which is pushing natural gas prices. Now the question is going to happen is, what is the average consumer going to do when this winter, when their electric bill is up 200% or 300%, and somebody says to them, well, it's not because we don't have enough gas here in the U.S. We have plenty of gas. We have enough gas to heat every home in America. It's because the gas that we're producing is not staying here. It's going to Europe. And so then the question is, what the sanctions that are they putting on Russia, who are they really hurting? Are they hurting Russia, or are they hurting Europe? And are they hurting, the average consumer here in the U.S.? And so my answer to her question is, I really think it's about the sanctions that are being incurred in Europe.
Yeah, I mean, obviously it's going to come down to the natural gas companies going, hey, where am I making more money? And unfortunately, you would think it'd be more of a patriotic thing, like, hey, let's take care of Americans. But it's like, if I'm going to make more money by shipping it over to Europe, that's where I'm shipping it. And I think that that's, part of the problem is this global capitalism. I mean, of course, I'm a capitalist. We are, most of us are. Noam says, let's go nuclear green. We can alleviate a lot of the problems with some of that, but we're stuck in this conundrum here with natural gas, and I'm a little bit bummed because I was in Boyle for a while, which is the triple leverage long, and I decided to bail on that one. Had some great winning on it, and I'm like, damn, I just should have kept that one.
Yeah, I got out of it way too early on that one too. But remember we talked about EQT, which was a stock that went from $15 to $45, or the LNG. Look at LNG; it's doubled. In last year. So, Cheniere. So, I mean, I think there's still plays out there in the natural gas market. I noticed on the EIA website this morning, I was reading the front page that said that they just approved a lot of new pipelines for exports. In other words, pipelines that take gas from, the Marshall area to the Gulf Coast, where they turn it into LNG. So I think the next wave in terms of equities in the natural gas will be the pipelines, the Williams, the Kinder Morgan, those kind of companies.
When we look at the commodities space, and we could just run down the whole gamut because there's so many different commodities you can trade in the futures market. I think it might be important to emphasize the differences because, if you go from something like the S&P futures contract and then you go to crude oil or natural gas or gold, they all have different, there's different specs, right? There's different amounts that the futures contract controls, but there's also different trading times and different lock limits. Is there anything that you would want to kind of caution anybody who's looking at going into the natural gas futures market? Is there something that they should know before they start buying NG?
Well, I mean, I think
the list is long.
The list is long. I think the key to anyone who is trading any futures contract, I think you start with margin, right? To make sure that you can afford those contracts in terms of the margin that you have to put up to allow you to take control of a futures contract. And so, you look at the ES and the NASDAQ, the margins are crazy, right? $15,000, $16,000, $18,000, $20,000. Right, but there are micros, so smaller contracts. So I think you start there. And the other thing is, understand who the main players are in terms of your commercials, who's driving your markets. And then another hint I would give is on a technical basis is one of the cool things you can start looking at is something called the average true range, which is kind of a measuring stick of volatility in terms of price action. And if you use that on a daily basis, or if you're constantly watching this market, it's a really good predictor of prices, especially for most futures traders. I think are shorter term, in other words, day traders or maybe small time swing traders from a week to week, Monday to Friday, that kind of thing. So I love the ATR as a technical analysis tool, and it's different across the board for all markets, but it's a tool that can be used in all markets.
I have mentioned in the past my liking of average true range. I think it's probably one of the most, at least for me, one of the most useful tools engaging in planning out my trade, right? Setting your stops and your targets. Of course, starting with supply and demand is obviously the number one piece. But then we add an average true range, and I think this kind of hones in a little bit. Talk to me about, I know you have an upcoming webinar, which, by the way, I will share the screen here for everybody. You can go to barchart.com. If you go to, normally it'll pop right up at the beginning on the right-hand side, but if you click on tools here, you'll see they have a whole bunch of different webinars. It says upcoming webinars and archived. If you click on the upcoming one, John will be doing a webinar on, believe it or not, average true range, which he says the Swiss Army knife for technical analysis. I like that. That's a good one. That will be coming up Wednesday. So tomorrow you'll be doing this one for 1 hour. You mentioned ATR and kind of your liking of it. Why is it you like it so much, and kind of how does it help you from an odds enhancer's perspective?
So, for instance, like I said, it's a Swiss Army knife of technical analysis. For day traders, it kind of gives you this measuring stick of probability. In other words, it helps you define a range of price for that day. And like you said, if I'm going to set my risk or I'm going to set my targets, it makes me be more realistic. I really can hone in on where I want to set my targets. Or in other words, when you look at your supply and demand zones, where I can be a little bit patient, right? I want to wait the market to come to me, or if I'm waiting for a contra trend price movement into a higher time frame trend, I'm going to wait for that zone that is on the edge of the ATR in order to enter that trade instead of rushing to get in. So I want to show you a couple of things, I mean, at least in that sense. But the other aspect of ATR in terms of risk management, for, let's say, swing traders, you can use it, a multiple of it, for off of moving averages or trend lines. In other words, a lot of times folks will put their stops right on a trend line or right on a moving average, and when price breaks below it, they stop themselves out. Well, what we can do is we can make the market close a multiple of ATR below that trend line or that that moving average before we exit the trade. Now that adds a little more dollar cost to our trade, but it eliminates a lot of whipsaw executions. For long-term traders, let's say buy and hold type traders, position traders, there's something called the chandelier effect. What you can do is you take a very recent strong high, in other words, an all-time high or a monthly high, and you do a multiple, like 3 to 4 times the ATR, and you set a trailing stop basis on that. So as the market continues to move higher, you keep moving your stop up. But if the market backs up 4 ATRs from that pivot high, then that would be a signal for you, or at least start to think about exiting that trade. Now, if you think about it, ATR never really goes ATR, ATR, ATR. But if you had 4 days in a row, you're probably talking about a 5 to 10% correction in your market. And again, I would only use this one if I'm at, let's say, an all-time high or a weekly high, or I'm getting close to my target high. So those 3 different concepts, day traders, swing traders, and long-term traders, is the versatility of the ATR. Okay. So let's start with that.
All right, I like it. And I've used it many times. Like for me, my greatest use, and again, regardless of time frame, swing, position, day trading, is just getting me to understand the animal that I'm trading. So regardless, we have a lot of people here who are in futures. You have a lot of people here who are in Forex. You have a lot of people who are in options, even cryptocurrencies. Every one of those assets is going to move at a different rate than another one. Hell, even the S&P and the NASDAQ are going to move at different rates over every different time frame. So I think it's critical to just outline from what you're trading. How does it move? How much is this doggy moving? I want to know those things, because now I can map out my plan so I don't put myself in a position where I'm either going to get stopped out too quickly or take on way too much risk when I don't need to, based off of an ATR. So it's a really tailored type of thing for me. I'm a huge fan.
It is. For instance, pull up a chart of the ES, the June contract.
Okay.
And so the ATR for, again, there's different ways to form it. Wells Wilder uses the 14-day. I kind of look at the 9-day, but equity traders, you could look at the 20-day. Now, what you'll discover is that 9-day, 14, 20, when you start looking at them, they're, the significance is usually small. It's usually about 1%. So it doesn't really matter. But I do lean towards the 9 for when I'm trading. I want to be a little bit more price sensitive to current prices. But let's use the 14-day for the ES, which is around 110, 112, 110 to 112 points. So if we subtracted the ATR from the closing price, now look at the price action from yesterday when market traded up, and then what did it do? It gapped lower after hours, right? On the next day, 6 o'clock, Bob Dunn style, right? Gap and go. It opened below the last candle, right? Let's say a 60-minute candle, gap and go. So that would have been a short signal. Now, maybe you didn't get into that trade until 8 o'clock in the morning. So now you know where your risk is that gap. But now you can also start thinking about setting a target. So what is the target going to be? Well, the target is going to be the true range. In other words, we'll subtract the close from the previous day minus the ATR, in this case around 112, And that would put us somewhere right around. I mean, you'd have to tell me, look at the chart there. I'm going to say it came within about 3 points of where the low was today. So this would allow you, if you took a gap and go, to collect a large percentage of the range, because you know that this animal, like you said, is going to move about 110 points today. And so we could set a target maybe around 100 points or 105 points and just manage risk in terms of long as it can go back and fill that gap, or as the market continued to move lower, maybe adjust my stop to lock in profits. That target, which was, let me look at my chart here, I think was around 75. So where was the previous day's close?
For the ESM?
Yeah. So it was around 73, right?
He closed at 71.75 is what I got.
Right. So we minus 110, 112. That puts us down around 38.70, right? What was the low for today?
Low for today is 38.72.
Bingo.
Nailed
there you go. Nailed it. Right? So I don't know if you use it. I think this is kind of how you use it, right?
I don't usually do it from the opens and closes. I'm lazy, so I don't usually get up at 6:30 in the morning here anytime anymore because I have so many assets that I can trade 24 hours a day. But I use it predominantly for establishing my risk. So if I was to go long on something at a specific price, I'll factor in ATR. I usually go more than one ATR, and that'll help me set my stop. So even if I'm on a 5-minute time frame, I'll find out what the 5-minute ATR is. I go past that and use that as a gauge to help set my stop. And if I can line that up with a demand zone, then even better. But the way you're showing it, I respect as well, because you're basically saying, I know that this asset moves this much. Therefore, if we're already there, it's probably not going to go much more than that. I can use this as a buy point.
Right, a buy point or a sell point or an exit or an entry, depending on what trend is playing out and what price action is playing out. Now, again, the way I kind of use it is I like to just use the daily ATR, and this allows me to use a different time frame, and then I'll use a smaller time frame for trend analysis or looking for my supply and demand zones. But I'm still targeting, I'm still looking for the zones that are going to be extrapolated from that daily ATR. Right? Does that make sense?
Yeah, absolutely.
Okay, so here's another great example. Let's go to pull up like an hour chart of gold.
All righty, hourly of gold. There we go.
All right, so we have been in, for the last few days, gold has been kind of creeping up. It's a small little uptrend. So we made a low last night during the European session, and this is one of the cool things about ATR is ATR doesn't care when the lows and highs are made. But when you were talking about different creatures, gold is definitely a global market. In other words, that when Europe opens, gold is an active market. So we see a low, right? And then price rallies up a little bit. And then during the day, we came back and tested that demand zone, right? Mm-hmm. We came back in which would kind of been a demand zone. So that would have been an entry point. Now we can say, well, how far could price go? Well, as long as that trend is in control, as price moves throughout the day, then I could see it go all the way up 1 ATR. So how far did it go? Well, the ATR for gold is around $28. So we added $28 around that 1851.5 level. I think that was created around 3 o'clock, or excuse me, this was around midnight from the night before. But add that to our numbers, and that puts up us in around the 1875, 1878 area. So again, now I'm going to say, all right, that's going to be my target. Or if I'm looking for a short entry, because gold has been in a downtrend, a much higher time frame downtrend, I'm going to wait patiently. I'm not going to look to sell that supply zone around 1870. I'm going to look for this supply zone that is higher than that, where I'm at the extreme of the ATR. And if we look to the left from that 1875, 1878 level around May 9th at 8 o'clock in the morning, I think Central Time, which would have been about 6 o'clock in the morning your time, there is a beautiful supply zone that was created. And where did price today stop? It literally stopped on the number of that supply zone, which was about 85, 90% of the ATR from last night's pivot low. Pretty cool, right?
Very. 1 sec. I'm just adjusting because I was on the continuous contract, which makes it slightly off. So there we go.
Yeah, go to the August contract.
Yep.
Yeah.
There we go. I have it I have it on the June, but either way, it still lines up much better.
So we're out of the June contract.
All right. So let's see.
Because the numbers will be a little different.
Let's go. GC. All right. August it is. Yep. GCQ. All right.
So
there
you can see the low was made around midnight, around 1851.50. The ATR is around $27, so that projects around 1878.50. So we want to look for a supply zone to the left, somewhere inside of there, and there's one that on May 9th at around 8 o'clock in the morning that was between 1875 and 1878. Do you see that?
Yep. Clear as a bell.
And where did we go to today?
Yeah, right to it.
Right to it.
Yeah.
Right? So you could have played this from the long side. Where do you get out? I'm going to get out just before that supply zone. If I'm looking to take a short, I'm waiting for that supply zone to come into, right?
Yep.
And again, in this trade, just on a day trade basis, well, I'm risking what, $3. Now on this trade, it came out of the zone about $9. So what's that? A 3-to-1 risk reward ratio for a very short term trade that came in around 10:45 in the morning and gave you 3-to-1 by 1:30 in the afternoon. So I mean, that's not a bad trade either, right?
No, that's a beach sharp stick in the eye, that's for sure. Now with these markets like this, there was a question earlier, and I thought maybe it might be nice to get your take on it. Asking kind of, what is your hypothesis here? So obviously we're seeing some great strength in commodities. Certainly gold and silver starting to trend up a little bit over after their sharp declines. But what's your thoughts on the overall market? Bear market time, short them if you got them, or is this just a pullback for a greater uptrend?
Yeah, I've been in the bear market camp since January. If you go back and look at some of my archive videos, I did one in the end of January called "How to Determine If You're in a Bear Market," and even at that time, the indexes were still kind of in an area of distribution, I would call, but a lot of individual stocks had already were in bear market territory. So I really believe that we are in a bear market and that we're only in the first phases of it. Now, one of the characteristics of bear markets is bear market rallies, and they're very vicious and very and long percentages. In other words, you can get a 10% correction in a bear market, and it confuses you. You wonder, this isn't the new bull market. But
right.
I still believe we're in a bear market for a lot of the reasons. First is don't fight the Fed. Well, the Fed's going to be tightening interest rates, so I don't like that. The second is I really believe that we're seeing stagflation. In other words, rising prices, commodity prices, futures prices around the world it's not just natural gas, but if you look at food prices, you look at car prices. I saw a thing, Redfin said that the home mortgages mortgage payments are up 43% from last year. So even though they say the consumer is doing well, I don't believe it. I don't believe that story. I only know what I know, and I know that even somebody like myself, the way I go around, I was like, hey, I'm not paying $4 for a block of cheese. That's ridiculous, right? And so my consuming habits have changed, and so I think what we've had was we had peak earnings of all these corporations, and now these headwinds of inflation, labor inflation, cost inflation, transportation inflation are really hitting these companies. So I think that the equities market is in trouble, and I think we're going to get another one or two legs to the downside. And I think maybe that capitulation might come. We have this kind of historic value around September, October. Maybe that might be where we might find a bottom. But until the Fed stops raising, I don't think we're going to be out of this for a while. Now, I'm not saying the sky is going to fall, but certainly maybe we might be in a range-bound trade for a while. So that's on the equity side. On the future side, because I'm always looking at, I really think the next great play, and it's already been playing out, but I think the next great play is in the agricultures. I really think that we're in for some troubled times in terms of supply and demand, in terms of real supply and demand, in terms of grains, coffee, sugar, cooking oil. Look at like soybean oil. It's up, it's doubled in the last year. But you look at like canola oil, that's one that's almost tripled since last year. So, those kind of inflationary pressures on the market, I think, are not good for the equities market.
Well, I'm in your camp. I'm a bit more bearish, I think, and I agree with you on all your different justifications for it. The main one, I think, is just the Fed needs to unwind their balance sheet and start to retire dollars, which is just going to drive the dollar up more, which is going to increase the yields on all these different bond products. And I'm curious to see the effects of people being priced out of buying homes. I mean, some of the economic data we had today did not look very good. So for those who are paying attention to the data today, I'll bring that up here real quick just to show you. 1 second here. There we go. Here is today's earnings announcement. We don't really care too much about that. You had some hits and misses, but this is really where I think the difficult times are starting to show up. You look at the flash services and manufacturing numbers for the U.S. We dropped on both of those, but they're still okay. Richmond Manufacturing Index is negative, went negative today. But the real big one here is these new home sales, right? They were expecting new home sales to go from 709,000 to 751. Came out at 591. I mean, that's a huge miss on those numbers.
Yes.
And if you think of the housing market as such a driver of GDP and economic growth, if we're seeing those numbers decline like that, what that means is next month and then month after that, if you start to see existing home sales start to decline, that means that the rising 30-year fixed rate mortgage is starting to impact, could be a much bigger domino effect. And they say don't fight the Fed, but I got a question. What can the Fed do? They've trapped themselves.
Well, I mean, in terms of what the Fed is doing, what is the Fed doing? It's raising rates, right? So you have to think about that, and I think that's what we can't fight. We have to wait for the Fed to finish tightening. Now, on the other side of the coin, as you talked about, manufacturing and industrial, and again, this thought about recession. You look at it on the consumer side, where everybody says, "Oh, the consumer is doing fine. Look at the consumer spending is up." Well, that's because they're spending more money for fewer goods, right? Mm-hmm. I mean, that's not a good thing. So sales are up, but they're selling less, right? Also, the other thing that I saw recently that really concerned me is consumer debt, right? Has gone up dramatically. I mean, I don't remember what the numbers were, but people are swiping those credit cards to pay off, pay their debt. So that's not a good thing, because just like mortgage payments that have gone up 43%, I'm wondering what, the average Joe who has now $10,000 worth of credit card debt that, 3 years ago, it didn't really matter because, my credit card was only charging me 8% or 10%. But now my credit card is going to start charging me what? 25, 30%, right? I mean, that's another headwind that the consumer is going to face, especially if they're starting to service their debts with credit cards. Yeah,
it's going to get, I think it's just going to get a little bit uglier going forward. And I guess, I've been telling the viewers here, now's the time to just, I would say, curtail your spending, right? Tighten up watch your money, make sure you got your debt down, and it could be a rocky road for the next couple of years, and that's okay. It happens. I mean, we've had that happen time and time again in financial markets. The key is to make sure that when you do have these downtimes, it doesn't wipe you out, and ideally, you capitalize on it and do well. Unfortunately, I had two huge positions over the past couple of years, which made money on one, lost pretty good on another. I've had a bunch of shorts along the way, and I have no short positions right now, which is driving me crazy because I closed them out over the last couple of weeks. But I'm waiting for that rally. I want that bear market rally so I can short the hell out of everything, man. Give me a pop.
It's exactly. You and I are like really on the same page, because I covered a lot of my put positions last week on that big sell-off that came, and I don't have any hedges on right now. I don't have any short calls. I don't have any long puts, and that makes me kind of nervous. But I think we're okay, because Today's price action really kind of tells me that between now and the end of the week, I don't think the market is going to fall out of bed unless some huge catalyst comes. As a matter of fact, I wouldn't be surprised if you see prices drift higher between now and the end, because it's a low volume week. It's got a holiday and all that kind of stuff. So I think we'll get that little bear market rally. I don't know how much we're going to get out of it this week, but maybe we'll get that the S&P above test that 4,000 again, and then we can put those hedges back on again. So I agree with you 100%. Let's wait for those right opportunities. So, I don't want to self-plug, but after next week's, I'm going to have a webinar. It's called How to Trade Bear Markets. And in that one, we're going to look at how to be a little bit counterintuitive. In other words, because bear markets are so volatile and have big price movements, both up and down, is we're going to wait for those bear market rallies to look for opportunities to sell calls in all of our long positions just to protect ourselves, and also look for opportunities to buy puts when the market feels like everything's back to normal. And then when we get those big elevator drop sell-off days, that's the days where we're going to take our profits on our puts, but also look at maybe picking up some call spreads on stocks that we like, that we think are cheap. And if we're wrong, all we're going to miss out on is that small little premium that we're going to put on that call spread. But if we're right, in theory, we might see that one leg of the call expire worthless, and we could exercise the other leg of the call and get into some cheap valuations. So that's what we're going to look at a week from now.
And as I showed you guys before, if you go to barchart.com, go right to the front homepage, click on Tools, and you'll see upcoming webinars, and all the registration information will be there for the one he's doing on ATR and any of the upcoming ones. Plus, and there you can see the secrets to bear market, and what's going after that? No? Oh, he does have some more. No, those are old. These are past ones. But
past ones, yeah.
No, past ones there. Margaret, you asked an interesting question. Margaret says, so what commodity ETF should we buy? I don't think that either one of us can make it like this is what you should buy. We're not financial advisors in any way, shape, or form. But I think if you are in the camp that believes, hey, commodities might perform well here, particularly agriculture, there are some ETFs to look at. I really only look at 3 different ETFs in the space. Let's go to, I'll show you the charts here. So if you're looking at just straight commodities, I generally am going to go with DBC. It's primarily because it's the largest one out there. This is an Invesco Commodities Index. It's got everything in it. It's a huge, it's got metals and grains and all kinds of different stuff in this one. To find out what they're in, you can use barchart.com. You just go to barchart.com, type in DBC. All right, and you'll see right there at the top, it brings it up. And then if you click on constituents on the left-hand side.
Excellent, Merlin. Excellent.
You can see here, it's showing you all that's in there. I mean, you can see you've got gold, corn, soybean, zinc futures. You've got copper, aluminum, wheat, crude oil. The other one I like to look at would be GCG, but it's not as liquid. Is it GCG?
The Goldman Sachs one?
Yeah.
Yeah, I forget.
I think I might have the ticker somewhere.
Our symbol is different. I forget what it is, to be honest with you.
Yeah, I thought it was well. So then from an agriculture perspective, I would do DBA. So this is the Deutsche Bank agriculture one, and again, I'll do the same thing here. I'm just going to type that one in, and if you click on constituents, it'll give you an idea of what that exposure is. And I think that this is really important for anybody who is looking at buying any ETF. You kind of want to know what the holdings are, and you can see here that it's corn, soybean, sugar, coffee, cattle, cocoa.
Excellent.
You've got pretty much everything in there. And if you want huge exposure to lean hogs, well, this one doesn't have massive exposure there. It's 7.9%, but at least it's a way to filter through and look and make sure you're holding what you want to hold. So that would be my recommendation out there.
But even on the bar chart ETF page, you can go in there and you can filter out not only by commodities, but actually very specific commodities. In other words, metals or grains, and you can go down and really, like there's a wheat one, there's a soybeans one, there's a corn one, right? There's, Boyle and the natural gas one.
Mm-hmm.
I would say who was it?
Margaret asked that question.
Margaret is, be careful of the multiple leverage ones, like for instance the Boyle, because
Hmm.
yeah, you do when they go up, you do really well, but when they go down, that's like, you can get a big big hickey. Um,
Everything's
you know,
great if it's on the leverage is awesome if it's working in your favor, but if
yeah,
it's going against you, man, leverage you're cursing everything under the sun. And just to further show you what bar chart has, I just went to their ETF, I did the screener, and I switched over to commodities, and you can see here what John's talking about. Here's you want just 1-to-1, great. Then take off all this. Oh, I don't have the membership fee, but if you get a membership, you can take all these other ones off. And, and,
right.
and I personally am not a fan of the triple ones, especially for if you're holding them long term. As a day trading thing, yes, I do like them. One of the big things I will caution you on is always check the volume. I don't like to trade things that
Yeah,
are under 1 million, and you'll notice that a lot of these are under 1 million. So just because it says, the Van Eck Merck Gold Trust, well, it's under 1 million or right around 1 million, so I would avoid it.
right. I would agree. I would actually lower my threshold on some of these commodity ones to maybe a couple 100,000, but it'll certainly, I agree with you on that one. Now, the other thing you could do is you could look to kind of do a little bit more diversification. Is we could look at, let's say, some emerging markets of particular countries that are commodity rich. In other words, for instance, Brazil, which is the EWZ, or Australia, the EWA, and Canada, EWC. These ones, now you're going to get other equities in, you're going to get some banks and stuff like that. But, here's kind of how you're going to play the commodity space through the equities markets through a country that is commodity rich. Does that kind of make sense to you?
Yeah. Yeah, I think that makes it a little more complicated. Just not the explanation, but I think when a lot of people, and you've worked with hundreds of students as well, John. I think a lot of people may not know. Oh, well, this country is good for this commodity and this commodity, right? I mean, we have the general ones like what Australia and Canada with oil. But you look at wheat. Like, well, who's one of the largest producers of wheat? Which economy should we look for that? Well, Russia.
Yeah.
Surprisingly, it's Russia. But, that takes a little bit more digging. I think that, if you are in the camp that you say, hey, I think wheat's going to be doing really good, then you can search for a wheat ETF. And maybe line up the 3 or 4 different competitors or choices you have and find out which one may have the strongest exposure to specific wheat products, and which one has the lowest management fees, because they're all going to be very, very different out there. But ETFs have really changed our ability to access these futures products or these commodities markets without having to buy futures. So I think it's a great resource.
I agree with you. I'm not a real big fan of ETFs. I'd rather buy the individual stocks or equities that are in there, or I play the future side of it, because when you, like you said, when you buy one of these ETFs, you might want one very critical piece, but you also get a lot of junk too sometimes, right?
Yep. One last question that I'll do an example of here. This was from Northside. It says, is it possible to filter it to show only strong buy ETFs? Well, it's not just going to be showing you, it's not going to flash a buy recommendation because it's not a financial advisor, but you notice that I can sort it by the 1 month % change or 3 month % change, so you can kind of see how it's been performing, and that gives you a clue as to what the trends are. But just because something's up, 30% in the last month, again, I still don't think that warrants a buy, right? I think let's say you look here at GAZ, right? So this is a natural gas ETF. It's up 34%. Well, I would certainly take a look and go out and look at GAZ and do some analysis on this first, right? Just because it's up that much doesn't mean I necessarily need to buy it right now. Of course, this piggybacks on the discussion John and I have had about natural gas on the show today. But don't let a 1 month gain or a 3 month gain be your dictator to buy something. Look at that price chart and know the risks that are facing you right now on GAZ. You're buying almost all-time highs for this thing. I mean, it's
right.
It's kind of tricky.
Go under ETFs, look underneath there on the pull-down menu. We do have a page that says top 100 ETFs, and if you look in there and click on that, that will show you the top 3 ETFs are the natural gas ones, the 3 natural gas ones, the UNL, the UNG, and gas, right? And then from below there, then you have energies, gasoline, natural gas. You have your DBE, right? That's the energy Investco. So we do, as part of our webpage, we do have ways where you can filter out the buys. Now, we also have what we call technical analysis, where we look at 13 different technical indicators, and we create a buy signal. And we do have some ETFs that will have, let's say, a buy signal that all 13 technical indicators are in a buy sign, which would be 100%, and that would be a huge buy signal. So there are ways that you can look at ETFs and look at buy signals through bar charts. So I mean, it can be done, and we do offer that.
There you go. Awesome. Well, again, if you guys want to know more, check out barchart.com. You can also find out more about his webinars, which he does every week. Tomorrow's will be on average to range. Next week is going to be trading a bear market. So I would encourage you guys to check that out. Just click on tools. You got upcoming webinars, and there you'll see all the registration information for that. John, thank you, my friend. I appreciate you coming on. It's
I'm a pleasure.
I'm gonna keep pushing to get you on once a month. I think a once a month touch up on what's been going on is going to be pretty good for us.
I listen, once a month, 6 weeks or so. Yeah, that's fine. I don't have a problem with that. I enjoy being with you, buddy, and I think it's really cool to talk about markets. We're kind of isolated now with COVID and all that and the new normal. And I miss that camaraderie that I used to have on the floor where I could talk markets with guys. And I know that spiritual debate. When you're right or when you're wrong, or when we're, all of a sudden I have an idea and I express it to you and you say, that's kind of what I was thinking too, right? So I miss that. So I would look forward to our conversations in the future.
Well, hopefully you and I can maybe teach some kind of class somewhere at some point. I do miss seeing you in person, my friend. Well, let me know if you're ever out in California. We'll bring you over to my studio and we can do a live show here.
With TJ, as long as TJ comes out.
I'll have to bring him down. TJ's like a golf star now. I don't know how he became a golfer, but it cracks me up. All right, John, thank you so much. Have a fantastic remainder of your day, and have a great webinar tomorrow.
Thanks a lot, Merlin.
All right, take care. Guys, that was John Rowland of barchart.com. You can get more information by going to barchart.com, or you can just go there and sign up for his webinar tomorrow on average to range. I agree with Margaret. ATR free webinar sounds great. Look, it's free. It's hard to throw shade at something that's for free. It's even better when you have somebody who's got so much experience as John Rowland does in the utilization of these or different topics that he's covering. So check that one out. Should be a pretty good session over there tomorrow. Let's see, Steven, you actually brought up a comment I wanted to mention. This one, it says, it wasn't the free account one. He was saying that this current market, which I think this is very important, especially for anybody who's got somebody about to retire. He says all of this screws older people. Yeah, and it's not designed to screw older people, right? It's not like the administration is going, let's screw some old people. Let's cause hyperinflation and raise prices and then crash the markets. It's just the natural flow of markets. Like, I pray that when I finally say, I'm done, I'm going to retire, collect all the money in my 401k, I hope that it's on an upswing, and it's right as those markets start to take off. So I've got a good, 5, 6, 10 years of just appreciating accounts. Unfortunately, it's all about market timing, and some people are left buying or left retiring as this market crashes. I mean, hell, we look at the S&P and NASDAQ stuff down almost 20%. If you retired in January, all of a sudden you had this nest egg, you're thinking, this is it, this is what I'm going to retire off. Well, you got 20% less now. And, that can evaporate pretty quickly. So I agree with you. I think it does screw old people, and I think this is why it's so important to get versed on how to protect yourself, even if it's just going to something as simple as cash. So there we go. Cool. Yeah, let me know what you guys think of the webinar. I was actually talking to those guys, and maybe down the road I'll do a webinar for them as well. They've got a great product, and I like to use bar chart for a lot of my things, my analysis stuff I do. All right, let me wrap up and go into real quick. Did I get this all done? I have a couple of questions I want to get to, but I'll get to those on tomorrow's show because I got to wrap up. We do, by the way, have a popcorn trade of the day for tomorrow. I know you're all excited. You want to see that great graphic right there, the popcorn trade of the day. Now, The popcorn trade of the day is going to be an interesting one. It's already down significantly. I mean, this one has been one of Larry Jacobson's darling stocks. It's one that he loves. I actually am a fan of it as well. But I do think you got to wait to make a buy on this one, and that is NVIDIA. NVIDIA is coming out after market close, so is Splunk, Bank of Montreal, and Dick's Sporting Goods. But while we're on that topic, let's take a quick peek over here at NVIDIA to see what it looks like. It's been really ugly, and to me, this is a clear definition of a downtrend. It's lower lows, it's lower highs, and at this point, I don't know if I would be a buyer of it. I would rather wait and let this market do what it's got to do. If we go back to the peak here that we saw on November 22nd to where we are right now as of the close today, it's down 53%. Could it go lower? Yeah, absolutely. So it could definitely go lower. And the question is, where might it stop at? Well, you do have a pretty decent spot right around 138. And who knows, with the way that this thing moves in the after-hours session, we may actually get that tomorrow. Tomorrow after close. It could happen very, very quickly. So be careful with that one. That's your popcorn trade of the day for tomorrow. As far as economic announcements, again, we do have New Zealand reporting their rate announcement tonight in just a couple of hours. They are expected to raise a full 50 basis points. That's huge. We've done that as well, but they're already going to jump it up to 2% is the expectation. And then here is what we have cooking for tomorrow. Notice already the pessimism coming into the equity markets. You can see here that the durable goods orders is expected to decline significantly to the tune of over 50% for some of these. It's pretty. I think they're lowering the bar so much that we may actually beat this tomorrow. But those numbers are not good forecasts for tomorrow with regards to durable goods orders. You do have a couple of FOMC members speaking. You've got Brainerd. I thought there was two. No, just Brainerd speaking in the FOMC meeting minutes, which of course is really important. And that's pretty much it for your economic calendar for tomorrow. So it should be an exciting one. I'm investing in the Merlin popcorn ETF. I don't know how you would do that. That would have to be a very active managed one. Basically, what would you do? You would go long on everything that reports earnings in a bull market, and if it's a bear market, you short everything that's reporting earnings. I don't know how you would do that ETF. Cash is a position too. Right on, Lori. 100%. You look at cash, and a lot of people go, well, cash is trash, right? Well, look what the dollar has done against global currencies. So if you're thinking of global purchasing power of your dollar, yeah, it's been gaining a lot of strength. Now, the past 2 weeks have been pretty ugly, and who knows, maybe we do get down to this 100 mark here before we surge back up. But I do believe that we have, I think it's 5 days away. If I'm not mistaken, I do believe it's going to happen starting on June 1st will be when the Fed starts to unwind its balance sheet. Remember, that's $47.5 billion a month of treasuries and mortgage-backed securities that they will be unloading on the market. So I think what you'll see from June on is interest rates starting to go up, meaning yields on bonds going up. And then you'll also see the dollar start to move back to the upside, as I believe they were going to be removing money supply. And therefore, we have this kind of self-fulfilling prophecy. Anyway, should be an interesting couple of days here. But that's your economic announcements and earnings calendar information for tomorrow. Again, if you guys have comments, questions, feedback, put them down below the YouTube video. That's the easiest way to help out the channel. Well, I guess hit the subscribe button and hit the like button and share the show. It's probably the best way to help this show. But if you have comments, questions, things you want me to talk about, you can put them down below the YouTube video or send them to TraderMerlin@gmail.com. Until then, I will see you guys on our Wednesday show. Take care, everybody.